Until then, that's what we've got. So we are right at the top of the hour. I see Andy, we have our guest speaker. We have a number of other folks on the call. So what I'm going to do is, let's see if I can do this. I'm going to manage to start the recording, and which is now done correctly. And I'm going to see if I can turn everybody's videos off, unless you really want to be on YouTube forever. Because that's where this is going to end up. And you don't get to turn your video off. You have to turn yours back on because you have the dialogue in a second.
Hey, Paul.
And there we are.
Hi, Andy.
All right. So everybody's got various familiar faces on. And what we'll do is, since we are at the top of the hour and letting a couple of people in, I'll dive in with the typical rules of the road, and we'll go from there. So it's top of the hour. It is March 9th, 5 o'clock Eastern time zone here in DC. And we are doing our third state of the firm call. And so we've got a couple of things on agenda for today for the YouTube. First is rules of the road. Second is going to be stuff that I'm talking about. And third is going to be a little Q&A with Andy and myself, followed by Q&A for everybody else who wants to dive in. And then everyone can go enjoy the rest of the evening and or have a glass of wine to while they enjoy the rest of their night or listen along. So with that, first part, disclaimer, please make sure everybody's muted so that we don't pick up any background noises. Feel welcome to turn your camera off if you don't want to be recorded for posterity for our YouTube channel, which will be getting uploaded to. It takes about a couple of weeks. If Andy decides he's got some handouts for us, we'll add those in. If you've got a question for the purposes of privacy, please drop it in a quick email to me. We'll be checking the email throughout the day, so that way folks can hop in. But we do ask that you keep your mics muted so that way it's nice and quiet. And next piece, my stuff. So really simple, really straightforward. Two things. Sorry, I've got the dog here. We'll start on the fixed income side. Since the last time we spoke, interest rates have moved significantly upward, over 1/3%. And so if you have an aggregate bond fund in your portfolio, you may have noticed that it's down a little bit. That's okay. As interest rates rise, prices fall in those bond funds. And so we're going to rebalance accordingly. It does, however, mean that your regular distributions are going to be up, though. And so that has created some pricing disconnects in the market. And so we'll be looking to take advantage of those. In addition, one of those pricing disconnects that we encountered since the last time we spoke is that the NASDAQ from its all-time high has moved into correction territory as of yesterday, which means it's down over 10%, which for our firm goals and philosophy on our model management, that's a rebalancing event. So a number of you are going to see trade confirmations in your inbox. And so I ran that this morning, so I expect trade confirms will probably go out in the batch tonight or tomorrow. So if you see it and you're like, it's not the quarter, what's William doing? That's what we did, and that's why we did it. Next change. We did modify one of the equity portfolios earlier in the year. One of the equity portfolios, and this is one of the all equity portfolios, we've added in a little bit more of a NASDAQ growth small cap focus. And so it's going to behave a little bit differently than the core individual equity portfolio that we've been running for quite a while. And the reason for that is that we wanted to give some of our clients a little bit of equity diversification in terms of how their portfolios were being run, and a little bit of additional option in terms of money manager selection. So You may see some companies like Lemonade, or you may see some companies like Carvana creeping into your portfolio, and that is part of that strategic shift as we're adding in and building out some of those equity positions for that stylistic change with that one particular portfolio, which some folks may have a small allocation to it. So if you've got any questions, always schedule some time, reach out. Mariah, Charles, anybody, schedule some time. We'll make sure that we go over the account and make sure you guys see what's going on. So that's the portfolio side of the stuff that we're doing and making some changes to. The next thing that I have to dive into is actually really important. I've been talking for the last couple of months about some updates that we've been making on the technology side. Precise FP, connecting things into the financial planning software. The next little fun piece of that I want to make sure I roll out on one of these calls, and I'm going to do a quick screen share with you all right now, is some updates to good old Wellscape. I know not a lot of people log in, not a lot of folks use it on a regular basis, but I want you to know that over the last couple of years, the folks at Fidelity have been making a lot of upgrades to this software. And so if you haven't logged in a while, or you can't remember where your login is, again, reach out to us. We'll make sure that you get logged in. A couple key features that I want to add in, especially so make sure that people are aware of, are now with your login. Before, we used to have those clunky numbers and you just got to assign a number, you can change your username. Now you can change your username, make sure, change it to whatever you like, so you can actually have a username that you've kept on file. The usual stuff regarding accounts, we can kind of customize the center view now, and we can help walk you through it. This stuff looks the same as it always has. And we'll send out and we'll supply this link. It's coming to the website soon. One of the nice parts is that you'll be able to select your electronic document delivery and confirmations a little bit easier. This is going to be easier to find on the website. Before, it was in the settings section, and it was a little bit tricky. And so enough advisors like me said, hey, can you guys make this more accessible? And they did. This is that usual spot that everybody is used to seeing. Remember, your accounts are in the top left corner. For those that like to analyze their own ETFs, they've made some improvements to the securities screener. Say that 3 times fast. Trading, we don't have anybody who does a lot of their own trading. This is the key piece where I think it's a really nice improvement. So there are a couple of pieces regarding how you move money into, out of your account, or across accounts for those that like to do some of this work. Before, it's always been a situation where you pick up the phone, you call us, or whichever. Well, now you can actually move money between your accounts if you want to. We've got a few clients that are already doing this, where we've got some specific accounts. If this is something where you want to have a little bit more of kind of a banking type feel with your accounts, we can make sure that we set this up for you. For those in the 59.5 plus crowd, where we want to make sure that we've got money flowing to bank accounts, doing various things, or for those that are doing some of this banking with regular withdrawals or various other stuff, this is a great spot where we can manage things and make sure that you're able to monitor, review, and update as needed. So that's just a particularly nice piece, and we can utilize some of this cash management feature stuff as well, and we'll work with you to get it arranged and make sure that everything's functioning the way it should. The other thing that's kind of a neat little slide about this card, a neat little piece about this particular slide, is I want to mention this card down here in the corner. I don't know how big it is on y'all's screen, but I'll zoom in real quick. It says debit cards. One of the things we don't talk about often is that we can set this up for a debit card and for regular cash utilization, which a lot of folks do like having. So let us know if that's something that's of interest to you, to have a little bit more of a banking type relationship or banking type flexibility with your account, rather than the way we've traditionally done it, where we move money into your bank account directly and then you manage it from there. So that's the quick thing that I wanted to make sure we touched on in terms of a rollout and improvement for our platform. Uh, and we hope you guys like it. We hope you take advantage of it. And the part I will end on, as far as the improvement side is concerned, is that we can now add in those pesky health savings accounts. So you don't have to go to like a secondary third party provider, et cetera, and have to try and manage yet another login, because I don't know about you guys, but it's a lot to manage all of those logins. And Andy, I'm sure you can attest to it later. You get clients that send you like 15 1099s from various places, 1095s and 1395Bs and 5498s.
All the numbers.
Yeah, exactly. So we'll get into that alphabet soup in a minute, but I did want to show you all that we've got some improvements that have been rolled out on the platform, stuff that we haven't talked about as a firm in the past. We didn't want to jump in and be the first ones to announce these rollouts. We wanted to see how it went. They've been up for a little while, and we're just starting to take advantage of them now that we've been hearing a lot of positive feedback. So that's the simple bit of it. We'll make this link available for folks that want to kind of review it in greater detail, and we can talk about it even more. Also, improved web capability on your mobile devices. So your smartphones, your dumb phones, your various phones, not your Cricket phones, it's got to support apps. Anyway, that is the simple case of it. And by the way, I tried on my flip phone that I have, it didn't work. So your phone does need to support apps. So with that, we're going to dive into the fun segment. Andy, you and I have known each other for a really long time. And I mean that it's been, what, 7 years, 8 years, something like that. It's been a while since that we've been working together. I know it was before I was at Cambridge. Yeah. So
maybe longer than that.
Yeah.
Feels like 30.
Yeah. Anybody who's known me for a while, there's a lot of that. So I guess I need to disclose the whole relationship. Andy and I have been working together for many years. We've worked together with a number of our clients. We have also had a relationship with Gearing Up Bicycles, which I've done some more work with, and he has just, I can't say enough good things, has stepped in and helped with that organization during transition period during COVID-19 and us losing an accountant and getting some various things done. And so with that, I guess we'll dive into the Q&A. I put together and supplied Andy with really one question in 26 parts. For those who've seen the TV show, or the movie, I should say, with Rodney Dangerfield, Back to School. And it's all the common questions that I get when I'm sitting at the table with clients, when I'm sitting at the table with you all. And I felt like it was best that someone hear it from, someone other than me. So with that, I'm going to throw out a couple of easy ones. Andy, let's talk about basic filing deadlines real quick. So I know April 15th is the big one. I know as a business owner, like by February 1st, I've got to get some 1099s out. But I know March 15th is a big one for me filing some business stuff. But what are some other key deadlines that should be on people's radar?
Well, hopefully this year, there's rumors that they're going to move it to June 15th, so we'll see. And yeah, that would be nice. I don't know. They might wait until after the March 15th deadline to announce it like they did last year. So businesses still have to get a filing in by next Monday. W-2s, if you have household employers, are due February 1st, the same day you talked about getting your 1099s out. And obviously everyone knows the individual Fed filing deadline's April 15th. You can get an automatic extension. I don't know why they call it that, because you still have to file something to get it, but you get an automatic extension until October 15th. if you want more time to file your return, but that doesn't give you more time to pay your taxes. So you'll be best sending in a payment with an extension. But it does give you and us more time to get the returns filed. Uh, and I don't, there's not really any other dates that individuals typically have to worry about. If somebody works with a nonprofit like Gearing Up, it's May 15th. There's a 15th on every month except July and August. So,
Okay.
and there's even July 31st for your 401k plans. That even the individual ones after they reach a certain level.
Yeah, that's that magic 250K number, which I'm hoping maybe one of these days they'll change, but no such luck as of yet.
Right. And there's also, I'll throw out, there's a lot of people are probably in different states, and there's a lot of different state deadlines for different things. If you're a small business and you have to, every state has some type of personal property tax form you have to file. Maryland's is due April 15th. Virginia's is due, I think, May 1st, and DC is due July 31st. So always something.
And some of those counties in Maryland have their own municipality filings.
Virginia's worse.
Yeah, like Virginia's got something in PG County. PG County does as well. So I guess the real big thing is that if you own property in multiple states, just be wary. The deadlines that, just double check your local community and municipality deadlines for those tax districts. Yeah, Florida does stuff by county. And if you have revenue in Florida, you have to file a return each and every month, even if you don't have revenue in that month for your revenue generating property. So yes, all kinds of things depending on each jurisdiction. You mentioned 401ks. Let's talk qualified plans for a quick second. We got IRAs, we got 401ks, we got Roth IRAs, we got a lot of stuff in there, the whole alphabet soup, SEP IRAs. One of the things that I hear oftentimes is, well, I want to file an extension. Can I wait to put money into my IRA, or do I still need to get that money in by April and have it count? I always like that money to come in sooner rather than later, or incrementally throughout the year, just for smart investing. But let's talk about what the IRS actually says, because they changed a bunch of rules after the Tax Cuts and Jobs Act.
So the first thing is, if you have a SEP IRA, because you have your own business and you're putting money into that type of plan, don't do it early because you think you can put away a certain amount. Wait until you figure out what your net income is for the prior year. And even if you file your return in April, you can still take until October to put the money in in the following year for the prior year. So it's good. It gives you 6 extra months to come up with the money to put in the retirement plan. If you're doing a regular IRA, you have to have that in by April 15th of the current year if you want to do it for the prior year. I think we had also talked about 529 plans, and I don't want to jump around too much, but I get that question all the time. Can I put money into my 529 plan for the kid, and can I put money into my IRA? That's typically, every state's different, but most of them are December 31st. You can't put it in the next year. But IRAs you can fund up until April 15th of the current year for the prior year. You can't go past April 15th, even if you get an extension, like you can for the 401k plans or the SEP IRAs. Also, with those individual 401k plans, every one of them is different. So it's good to read the plan documents. Some of them, there's an employer and an employee contribution. And some of them say that you have to make your employee contribution, which I think last year was about 18,000. That has to be done by December 31st, and the rest can be contributed as the employer portion up to the extended due date of your return. But it's different plan by plan, and everybody writes a different plan.
Yes, absolutely. And I know one of the things the common thing on the individual side is going to be that profit sharing piece, which you have all the way up to the extension deadline for. So, in most plans, you should be able to get that in all the way up to October, just depending on plan document info. So that works out perfect. So in terms of ratios, I did notice in 2017, the IRS codified what's called the backdoor Roth. Good, bad, otherwise, in terms of the backdoor Roth, I know that there are some specific rules regarding income limits with Roth. I regularly hear that. But with backdoor Roths, you put money into the traditional IRA or the SEP IRA, and then you immediately convert it to the Roth IRA. There's no income limits. But are there any other specific rules we should look out for? Because before the 2017, this hadn't been codified at all.
You got me. I don't know. To me, that's the only loophole left that people can put money into. They say specifically you can't put it into a Roth, but you can put it into a regular IRA and immediately roll it over to a Roth. To me, it's a waste of time. I don't understand why they do that, but it's a great deal. It's definitely something people should do if they. A couple of different factors go into it, age, whether you're going to need the money or not at retirement, or you just want to be putting money away because you don't have to take money out of a Roth like you do have to take it out of a regular IRA. So a lot of people do that rollover because they're not going to need to take the money out. They'll be getting it from their pension plan. They'll be able to live off that and not have to worry about taking money out of their IRA.
Okay.
Yeah, there's not many loopholes left. It's a shame.
This is true. Speaking of loopholes, let's talk SALT deductions real quick. Everybody loves SALT deductions, and so kind of here's the gist of it. I hear lots of creative things from clients about SALT, and one of the biggest questions I have, and what seems like on the message boards no one can agree on, is the real estate you own as your primary residence. Those of us here in DC, it's real easy to get to $10,000 a year in real estate taxes in the DMV area. Is that part of my state and local? Is it not part of my state and local? How does that all work?
Yes. They really did a number on everybody a couple years ago when they capped it at $10,000 this year for the first time. And I don't know every state because they literally just changed them in the last month or two, but I'll use Maryland since I'm in Maryland as an example. Maryland passed, this is for individuals that might be partners in a partnership or have an investment in a partnership. You can elect to have your Maryland state taxes paid by the partnership instead of you getting your K-1 and paying the taxes on your personal tax return. And what that does is it allows you to deduct those taxes on next year's return and also take a credit on your personal return for the taxes that were already paid on your behalf. And what that does is it avoids the SALT rule by not capping your taxes at 10. Because if your real estate taxes were $10,000, then it doesn't matter how much you had withheld from your paycheck in state taxes.
Excuse me, sir. I have a question.
Okay.
Do you think being a person of color is a factor as well?
Nope.
I'm guessing that's a bot that took over.
I think so.
Why not?
Not sure. So we've been Zoom bombed. At the moment. But anyway, I'm not sure how race, gender, ethnicity, or various other factors would apply to SALT deductions. But what I can say is that it's a pretty straightforward thing. If you have a business, also, Andy, as you just mentioned about business taxes and credit, DC requires us, if we have a rental if we have property and we rent it, like even an English basement, that we set up an LLC and that we have a rental. Can we utilize that mechanism to help avoid the SALT deductions as well, or are there some caveats that we need to be careful of in terms of?
So you can do that. I wouldn't necessarily say doing that for that reason is the right way to go. That's just a natural thing that would happen if you decide to rent out part of your place, where let's say you rent out the basement and you have 3 levels. 1/3 of those taxes will be deducted on Schedule E and avoid the SALT rules altogether. But you don't want to turn something into a rental where it's not actually a rental, just to avoid that.
Gotcha. Yeah, I was gonna say, I do know there are some zoning laws. DC's pretty strict with those.
And don't leave your property vacant either. If you go overseas, I just saw somebody get hit with a $75,000 bill for leaving their house vacant for a year.
Yes, you get, I believe, just under 12 months. It's like 364 days in the district on the vacancy piece. And the same also goes true, by the way, if you are having the property renovated. At least here in DC, and then after that, you have to file for an exception.
I'm seeing chat that maybe we misunderstood Anna's question.
Yeah, I was gonna say, I have to try. I can't see the chat while I'm moderating this. So in a second, when we get to the Q&A section, we will get to those various questions. Next on our list from the SALT side, I get some 529 plan questions on a regular basis. And one of my favorite ones is, my kids live in a different state. They have an account from the 529 plan account for my grandson and granddaughter. And can I just put money in there and just get the tax deduction? Or do I have to open a 529 plan in my own state? Now, I always say open it in your own state because then it guarantees that you get the deduction. However, I'm curious, are there certain states or are there certain situations where there's a loophole or gifting where there can actually be a deduction made?
Not that I'm aware of. Every state, you have to open your own account. It has to be in your name or the child's name, the beneficiary's name, and you make your contribution. Now, let's say the child or the beneficiary lives in another state. You still have, if you want the tax deduction in your state, you have to open up a plan in your state. So if you're in New York and your kid lives in DC, you have to open it up. You have to open up a New York plan. It shouldn't matter because you can use them at any schools that somebody wants to go to.
Gotcha. Thanks for that clarification. All right. And then I know what happens when your state doesn't have any income taxes. You're really just getting the tax deferral. But are there any other reasons that you ultimately, Texas has a 529 plan. Texas doesn't have any state income taxes. Like, what's beyond the tax deferral? Like, what's the actual benefit? Is there one from an overall tax filing perspective? Because I can't find one, but I'm not a CPA like you.
Well, you can put the money away. Basically, it's a way of putting the money away and having it grow tax-free uh, and investing your money without having to pay taxes on, as long as you use it for educational purposes. The state deduction that you get, they're not really that huge and life changing. It's more for the benefit of being able to grow money. Plus, it helps people put money away on the side where they want to access it.
So it's really just the straightforward piece. There's no other like hidden loopholes or anything that folks should be aware of.
No, and every state has different rules too. So uh, if you're over, I don't know if it's 55 or 65 in Virginia, you can deduct an unlimited amount for 529 plans. In Maryland, it's $2,500 per account per beneficiary. So it is state specific.
Yeah, here in DC, you've got to open if you're married and you have multiple children, each spouse has to open an account for each child. And so if you have 2 kids, it's really easy to get to like 4 accounts straight away in order to get the actual maximum tax deduction. So it can get tricky, and yeah, each state. So you have to check with your state. So that's the compliance disclaimer. Check with your own state rules. Certain states, allow for advisors to be on plans. Certain states do not. And if you have an advisor and you have a direct only plan, there are ways, and you want to work with your advisor, there are ways to get money into that plan. But consult your state and local rules first.
Yep.
Or
you can feel free to call and anybody can look it up for you.
Yes. Certain states, their help desk is better. Certain states.
Oh no, I meant call me or your accountant or anybody else. I wouldn't call the state because they never give you the right answer.
Correct. DC 529 is very hands-on.
Yes.
In terms
and
of,
yet DC is interesting because I believe in DC you can be a resident of DC and contribute to other states' plans and still take the deduction. I don't know if that changed or not, but you used to be able to do that.
Correct. And they've taken away any and all access to professionals like myself or to you.
Right.
So it's an interesting thing here. Next, kind of moving along, and we're getting close to the end. Let's talk really quick about.
Can I respond to Anna, because I do see her question in the text now.
Okay.
And I apologize for anything. I have seen things in my kids' school and their Zooms. I don't know the answer to your question about whether people of color experience the SALT deduction any differently than anybody else. I'm just an accountant who prepares tax returns, and I don't get into. I honestly don't have an answer to that.
Yeah. I will say DC being DC and a wealthy, diverse population, I get people of all stripes in my office that are dealing with it, from business owners to individuals to blended families to you name it. And I would say everybody is, I won't use the word afflicted, but affected definitely, pretty much the same way here in DC. And property tax has a lot to do with it.
Right. Yeah, I would agree. I mean, just from a macro standpoint, that law change definitely affected areas that are more diverse than other areas. I can't say it was a great law to pass. I don't think I'm qualified to get into whether it should have been passed or it shouldn't have been passed. It's just.
We'll work with it. We'll move on. We'll move around it. We did used to have, actually a long time ago, we did used to have state and local tax deduction limits. If you're a student of history, you can look it up. But All the rules have changed. I think that was actually as far back as the 60s. We had state and local tax deduction rules. Moving along, because we're about to enter into the Q&A period. So Andy, this is the last one that I'll kind of throw at you, and then we'll see if anybody else has some things for us. I get this one a lot. I want to gift money to my children or my grandchildren. Is this tax deductible? Are there ways that I can make gifts tax deductible, like through my IRA or various other things? To my knowledge, gifts to children and grandchildren really aren't tax deductible. You do want to be careful how much money you give them, so we don't encounter what's called kitty tax, which I can let Andy go into in greater detail. But beyond that, I can't think of anything straight away. How about you, Andy?
So as far as gifting goes, it doesn't even have to be family. You can gift anybody you want up to $15,000 a year. There's no deduction for gifts, but it is tax-free to the person receiving it. If you go over $15,000, you're supposed to file a gift tax return. You most likely won't be paying any tax with that gift tax return, but what that does is it eats into your lifetime exclusion of the amount of gifts that you can give versus what's left over in your estate once you pass away. The amount's over $11 million at this point. So let's say you gave away $100,000 to your son or daughter. You'd file a gift tax return saying I gave away $100,000, but you would then subtract that amount from the amount of your lifetime exclusion, which is $11 million. So you'd only be able to give away $10,900,000 for the rest of your life. So that would be a good problem to have.
Yes, I have a relative that refers to those things as high quality problems.
Right. Now there are other things I get asked about gifts all the time because people want to give their kids a gift for buying a new house and it's more than $15,000, but you can, if they're married, you can give their spouse $15,000. If you're married, you and your husband can each give each of them $15,000 and you're already up to $60,000. If they have kids, you can gift the kids and the parents can control that. So there's workarounds around everything.
Perfect. With that, we're going to open it up to the floor for everybody else. For anyone that has additional questions, we'll keep the sort of room open here for a minute. As usual, I ask that you guys email me directly, and we'll go ahead and read your questions out loud. So. Anyone raise a hand if you've got a question? All right. Well, nobody has any questions, which means it's 5:40. So it's time for us to end. And until next month,